Hey, Brent, good to see you again. Today we have 4 rules for investing after retirement. As you know, retirees have so much to juggle. They have to have safe investments to protect their income streams, but not so safe that they risk running out of money. And this is what brings us to point number 1. Watch out for inflation, which was the story of last year, right? But also this year. Take a look
Sure.
at the consumer price index, jumped 7% year over year. This is so important.
Absolutely. So yeah, your portfolio is going to need to have those growth positions to hopefully keep up with inflation. And
Mhm.
as you can see here, the CPI is essentially the weighted average cost of a basket of goods. So transportation, food, fuel, and so those are just the costs of living. And as you can see, it's up 7%.
Right. And that hits everybody, doesn't it? Right in the pocketbook. So,
Absolutely.
point number 2 is break your retirement into buckets. What does that mean exactly, and why is it important?
Yeah, so you're going to be retired for 30 years or more on average, and so you're going to need to have your assets split up into certain buckets. Bucket one is going to be cash. This is for stuff that I need, expenses for the next 2, 3 years. And then after that, you're looking for a low risk bucket, and you're looking for years maybe 4 through 10, where you do want some risk so you can get some growth, but not, too risky. And then that high risk bucket, you're looking for years 10 and on, and that's you're going to be looking for the growth stuff from.
Mm, yeah, that makes sense. Okay, let's move into rule number 3 here. Forget the 60-40 rule.
Yes.
I feel like I've heard about the 60-40 forever. It's been a long-term bedrock of retirement planning, but it's not performing well lately, specifically those bonds.
Correct. So for the longest time, the 60-40 rule, that was essentially the go-to for financial advisors. You set up a plan where a client could draw 4% on their portfolio and it should last for 30 years. And interestingly enough, the guy who came up with this plan actually is now saying that the probability of failure is too high for it to be recommended. And they're saying that it probably should be closer to 3% draw on those assets.
Well, if the inventor doesn't love it, that is something to
Correct.
consider. So I think that leads us to our next question, which what would be a good bond alternative or another safe investment and something that you specialize in? You say consider annuities. Why is that?
Yes, these are an insurance product. And the problem with bonds is the inflation environment, or the interest rate environment, rather. And so we're worried that those aren't going to keep up like they used to. And
Hmm.
so with annuities, we tend to work with two, the fixed and then the fixed indexed. Those are no lose accounts, but yet they still are known to get some growth. And then there is another third category, variable annuities. We tend to stay away from those because they're a little bit higher fee.
Right. So just to say this again, so you essentially can't lose your principal, but it's an alternate income stream when those bonds aren't performing well.
Correct. I'm glad you brought that up. Yes, they can be used for a guaranteed income stream, but they are also often used just for a safe growth alternative. So
Okay.
it could do both.
Well, that's very important then for retirees. Brent, this was really helpful. If somebody would like to talk to you more about these rules and why they're so important, what's the best way to reach you?
Sure. They can just head over to our website, www.young-wm.com. All our information's there. We'd love to work with you.
Perfect. Brent, thank you.
Thank you.